Nigeria's tax-to-GDP ratio is expected to improve in 2026 following the implementation of sweeping tax reforms that began in January, according to PwC. The reforms are projected to raise the ratio from an estimated 9.5% to 10.2% in 2026 and 12.5% by 2027, though still below the 15% benchmark set by the World Bank and IMF. PwC says stronger compliance, digital revenue systems, and better remittance discipline will drive gains. Improved revenues could ease debt pressures, but high debt service costs and a large budget deficit will continue to constrain fiscal space and capital spending execution in 2026. Abiodun Kayode-Alli, Senior Manager, Tax and Regulatory Services from PwC Nigeria, joins me now. Thank you for joining us.
Thank you for having me.
Yes. Now, how significant is Nigeria's tax reform in practical terms if tax-to-GDP ratio still remains below the 15% global benchmark?
Yeah, I think the tax reforms is actually a significant mile that we've actually achieved in passing them because of the reformation it's bringing to the way taxes are being administered in Nigeria. So one thing we can say clearly is that we've not done a fantastic job when it comes to administration of taxes. We find ourselves in a situation whereby, despite the fact that we've been trying to collect numerous amounts of taxes, a large amount of them officially, we have about 60 of them and unofficially over 200. We still haven't done a great job in increasing our revenues, right, from these numerous taxes. So in order to ensure we have efficiency, what this new tax law seeks to do is to bring about that efficiency by reducing the number of taxes that will be collected and also widening the scope, right, the reach of those who are paying taxes. And if you recall, back in 2017, when we had the voluntary asset and income declaration scheme under the Buhari administration, the vice president at a forum once declared that even though Nigerians had about 70 million economically active Nigerians, only about 14 million were actually paying taxes, which is something within the range of 20%. And even if you consider that particular amount I just described, it was said that only about 96% were actually under the pay-as-you-earn scheme, employees scheme, and 4% were the ones who were doing a direct self-assessment. So the summary of the statistics simply says that Nigerians have not been people who are eager to pay taxes or file their tax returns. And you won't blame Nigerians for that. And there is good evidence, good data based on certain research that was conducted by the Bill and Melinda Gates Foundation during that same period that says that Nigerians have a significant trust deficit with respect to how the tax authorities would actually how they collect the taxes and how they make use of those taxes. It's on record that there is that feeling or there is that perception that most of the taxes being collected from individuals do not end up in government coffers. So to remove all these leakages and stumbling blocks, that's the reason for the introduction of technology. And the aim, like you said in your introduction, is to actually raise the tax to GDP ratio, which has been abysmal, from within the range of 9.5% to something over 15%, 18% in the next 3 years. And the 18% is not a bad goal, considering the fact that the average tax to GDP ratio in Africa is 15%.
Indeed. I guess in 2026, the aim is 10.2%. And I mean, let's hope we stay on course. But a broad overview, are there specific elements of the new tax reforms that are expected to deliver the biggest boost to revenue in 2026?
Yeah, so I think that the first and important thing is the need for individuals, businesses to actually get a tax identification number. So the tax identification number would, to a large extent, identify individuals who should be taxable. Then there are also the aspects where the financial institutions also have a responsibility to report transactions. Even though we've been seeing different versions of the law, the final version of the tax law, which was recently released, says that this should be within the range of 50 million for individuals and 250 million for companies. And the tax authority can also reach out to the banks to give further details of individuals. So this, to a large extent, helps to identify people who should, the technical term is taxable persons, people who are carrying out activities and ought to some extent to be filing tax returns. So that would help. Then there is also the aspect of technology. And you know, technology, you've seen the wonders of technology in times like this with respect to identifying transactions. Other countries have used most of the technologies that have been introduced now remarkably well. I'm referring to even African countries here, African countries such as Rwanda, Kenya, Tanzania, and even Ghana, neighboring countries like Ghana. They've been able to use technology to a large extent to be able to ensure that there is ease of compliance with respect to filing tax returns, and there is also accountability. So these are some of the things that have been introduced in the new tax laws. Then I think one other aspect that we would also be considering would be the aspect of transaction taxes. So the beauty of the transaction taxes is that for companies, we know that they are more often regarded as the visible entities, right? Those with brick and mortar, they are more often the visible entities. There are things that have been put in place to ensure that whoever they are transacting with are actually compliant, because the truth is no one carries out a transaction in a silo. We don't run an autarky economy where you are self-dependent. You would need other individuals and businesses to transact with, and there are things in this law to ensure that whichever company is carrying out the transaction or is a party to the transaction, you are capturing other parties in that transaction. There are provisions in the law that says if you are giving contracts to an unregistered vendor, there is a penalty. So to avoid paying that penalty, you would want to ensure that all your vendors are actually tax registered. And there is also a penalty for those non-registered vendors, in the sense that the transaction taxes that will be deducted from their payment would be twice the rate that ought to have been deducted. So all these things, by the time you factor them in, right, these are things that will help us bring more people to the tax net, because the honest truth is that there are a lot of Nigerians who are not actually paying taxes. So these are some of the provisions that would help increase that tax to GDP ratio.
And as they begin, accountability will increase, and I imagine people will be more concerned about how taxpayers' money is being spent. Now, I mean, is the projected rise in tax to GDP from 9.5% to 10.2%, is it enough to materially improve Nigeria's fiscal health, or it's still marginal, it's going to take a lot more time?
And thank you. That's a very good question you've asked there. So Nigeria's fiscal health, it's something that would actually take place over a period of time, right? It's not something that will take place within a short distance, right? It's not like a sprint, but it's something more like a marathon. All right. So the expectation, if you recall the policy objectives of the current administration when they were about to roll out the proposal for this tax reform, some of the policy objectives had to do with making sure that the business environment was conducive and businesses were competitive when you compare them to their peers in other jurisdictions. So the idea is to stimulate growth, basically stimulate growth, because the stimulation of growth for most of these businesses have a kind of trickle-down effect. If you consider the fact that there is a provision that allows small companies, small businesses not to pay taxes income taxes from a corporate level, and as well as transaction taxes such as value-added taxes, development levies. They won't be paying these things. The idea is that, and the threshold for these small companies is companies that do 100 million and below. The idea is that if they don't pay taxes, they grow, right? It stimulates growth, they expand, and with that expansion and growth, they are able to employ more people. Those people would pay income taxes, personal income taxes, right? And those people would have enough purchasing power to be able to purchase products, right? Goods and services. And this kind of triggers the growth effect and the developmental effect alongside. So the idea basically is that over time, once these businesses begin to expand, they will then cross that 100 million threshold and then begin to pay taxes. So it's not something that will happen within a short period of time, but over a long period of time. That's for the businesses. Then the other aspect of it would now be those businesses that, or those individuals that have that make or generate a significant amount of money but are yet to pay taxes. So as long as do I call it the camera or the lenses of the new tax law puts that beam or searchlight on those individuals, they will be able to collect the appropriate taxes. And you can see that marginal increase to the 10%, to the 12.5%, and ultimately the 18% that we've spoken to.
And I think after this break, we'll get into why Nigeria historically has struggled with tax collection compared to even its peers, that the ones we like to compare ourselves to, the Ghana, the South Africa, Kenya, and so on. We'll get into that after this break. Do stay with us. Nigeria's tax-to-GDP ratio is set to increase after the latest tax reform. And we do have our guest with us to provide some perspective on that conversation. Thank you for staying with us, Mr. Abiodun Kayode-Alli.
Yeah, thank you.
Yes, and I think right now let's turn to why, so that we can learn from history and see whether that is being addressed. Why historically Nigeria has struggled with tax collection, especially when you compare her to her peers. Ghana is about 14% when it comes to tax to GDP ratio. South Africa is at, let me get this right, South Africa is about almost 30%. So what lessons can we learn from them, and why have we struggled so far?
Yeah, and that's a very good question you've asked. So Nigeria basically has relied significantly on resource oil, right, as one of its major wealth earner for a very long period of time. And more attention has been given to oil compared to taxation. Okay, so I think that's one thing we must say. That emphasis on oil has been something that has taken the minds as well as the attention of our leaders, right, from looking at aspects such as taxation, other sources of revenue. Then I think the next important thing that we must say is the social trust. Like I said earlier, it's something that over time research has been made, and even without even making that research, if you speak to someone on the streets, if you speak to your neighbors, and I'm sure even you yourself, you discover that a lot of times you find yourselves paying taxes, but you then ask yourself that social contract, is government doing what it's supposed to do with those taxes? So you see a situation whereby there is that reluctance, unwillingness to pay taxes, especially when you look at the lifestyle of our elites, those in leadership, right? You see a situation whereby lots of Nigerians are engaged in what is called black tax. Simply put, they are the ones providing their own infrastructure, infrastructure that should be a social good to be provided by the government in terms of pipe-borne water, in terms of electricity. It's gotten to a point whereby a lot of communities, a lot of businesses and individuals, they've gotten their alternatives in terms of getting a diesel-powered generator, in terms of getting solar equipment to be able to power their businesses, right, or digging their own boreholes. So a lot of these things are part part of the things that have caused that unwillingness to pay taxes. Then in the midst of it, you still have to mention corruption as a nature, not just from the government itself, but also in terms of the administrators, because you find yourself in a situation whereby as if you find an individual who is willing to pay taxes, there are probably some officials who would circumvent the whole process of ensuring that that money actually gets to the government, right? Looking for kickbacks. So these kind of behaviors, they kind of hinder and hamper the process in terms of tax collection. I know very well, and I'm sure you know as well, individuals who have wanted or shown interest in volunteering to pay taxes, but for some strange reasons, some individuals just comes and tells them to pay a lower amount without any form of certificate or without any form of receipt to show for this, right? So these are some of the behaviors that have resulted in that decline in the taxes being collected. And I think the final one we must mention has to do with technology. So if you consider the countries you mentioned, like South Africa is a country whereby they have a kind of technology, something similar to the automated teller machine. Imagine a situation whereby in times like this, we know we never had ATMs back in the 90s, if I'm not mistaken. We didn't have it, or in the early 2000s. I don't think we had it back then. But imagine a situation whereby you go to an ATM and you are able to pay your taxes, right? You're able to impute your details and it brings out your information. South Africa is a country that has things like that. In fact, in Rwanda, for instance, it got to a point whereby the government of the day decided that there was no need for taxpayers to begin to file transaction tax returns because they had more accurate information, right, that they could rely on. I mean, the government, right? So until we get to that point, that's when we can then see a massive increase in tax collection. So technology is one key thing that can actually bring about an increase as long as you can cut or reduce that human interaction that gives that incentive to want to cut corners, right? We would see a massive increase in collection.
Interesting. I think we'll watch and see how this all pans out. And I think it also brings back the chicken or egg conversation. Do we wait for the government to deliver before we pay our taxes, or do we pay our taxes and trust that the government will deliver in providing social amenities? Let's come to another, finally, an issue that has been contentious a little bit when it comes to the SMEs. Tighter tax enforcement, how it affects the SMEs and informal sector and businesses at large. How will it affect them in the larger part? There are those who are, I'm seeing videos online of prices are about to go up because they're going to transfer that extra cost to the consumer. So let us into how that works out.
So to be quite honest with you, every individual, every business would be a winner as far as the tax reforms are concerned. And I'll give you a very good example with let me give you two examples. So the first example I'll give you has to do with the income tax. So clearly, if you earn 800,000 to 1.3 million, you are likely not to pay any tax. 800,000 to 1.3 million per annum. As an individual or as a business, you are not likely to pay personal income tax based on the new graduated scale that we have. Okay. And also, if you are registered as a company and you are earning 100 million and below, 100 million is a lot. Previously, under the old law, it was 25 million. But if you're earning 100 million and below as a company, you won't pay tax. So that is more money in the pocket of businesses and individuals. Okay. And in addition to that, the chairman of the Fiscal Policy and Tax Reform Committee has reiterated that there is a presumptive tax regulation that is coming up to help artisans, bricklayers, organizers. Anyone earning 12 million and below, they won't pay tax at all. So you could pick that from the statements made by the chairman. So let's now move on to transaction taxes, the one you identified, something like VAT. Interestingly, if you are a small business, if you are a small company, 100 million and below, you won't pay VAT. That's a very good one. Then also for the individuals, a lot of the things that they consume, right, has been reclassified or recategorized in such a way that basic items that even though you won't see VAT on the receipts when you get your receipts, basic items like basic food items, educational invoices or medical invoices, even though you won't see VAT on the receipt, there was always an implicit VAT that existed. This has been totally taken out, right? So the expectation is that businesses would reduce their prices once they enjoy these benefits.
They better. But thank you for your perspective on the show today and the information you've shared with us. Abiodun Kayode-Alli, Senior Manager, Tax and Regulatory Services with PwC. Thank you.